All right, good morning. Good morning, everyone. Welcome to the Alliance of Angels webinar on the capitalization stack, getting the right funding in place for growth. Today, just before I get started, we're going to start off with a little bit of logistics. We are trying to keep this an interactive session. So if you have questions for our speaker, please don't be shy. Feel free to speak up. Or if your audio isn't quite working, you can also use the chat within this meeting, within the Zoom meeting, to send questions. So we do want to keep this interactive so we can all learn together. But that said, also, if you are not speaking, we do ask that you please put yourself on mute, right? So we have like a good learning and listening experience for everyone else. So before we get started, I'm going to share a few words about Alliance of Angels, the organization that I run. My name is E. Jane, and the Alliance of Angels is an angel investing organization. We have 140 angel investors in our group. Every year we put about 10 million into 20 companies. Most companies that are fundraising from us, they're looking for a total of between $500,000 and 1.5. And our typical check size is 250 to 500. When money comes in from us, it's usually in the form of 4 to 6 people, each person putting in 25, 50, or 100. And the sum total of that is 250 to 500. People make their own investment decisions, and their names go directly onto your.
那或者是在电话再跟他联系，您有他的电话哦。
All right. I hear there's some
哦，没
audio.
有，他的那个。
Hello, if you are, could you please?
他的那个。
他的个人电邮给我吧，我觉得把那个东西。
All right. So sorry for that. And to continue, we are a sector agnostic and stage agnostic investor. So it doesn't matter how early you are, feel free to come reach out and start a conversation. My email is at the bottom of this slide. So if you are an entrepreneur and you're fundraising, feel free to send me a note. Or if maybe you're an investor and you're interested in learning more about angel investing and my organization, feel free to send me a note too. All right, so again, thank you to all for joining today. And I'm going to stop talking and I'm going to hand control of the meeting over to our speaker today, Gillian. Hey, Gillian.
Hi, it's a pleasure to be with you all. I'm going to take the speaker role now, take a view for presenter, and let me know, do you see the slides?
If you could full screen that would be better.
It's not full screening. Bummer. Okay, well, in that case, you would get to see speaker notes. Okay, we're just going to full screen this, folks. It's not quite as elegant as usual, but there we go. How's that?
Yes, that's fantastic. Thank you.
Okay, good. And I see the chat box. Do you also see the chat box and the people and all that?
Yep, I do.
You do?
Yes.
Okay, I'll see if I can get rid of it. I will kind of hold the chat box here so that I can see a little bit, but feel free to interrupt me. So again, my name is Gillian Muessig. I'm the managing director of Mastersfund. It's a first venture capital fund by Outlines Venture Group. I'm going to run through a massive number of stats and history and this and that. And the next thing, I have backup documents and links to share with everyone. I'm going to share the slide deck with anybody who wishes here through the Alliance of Angels. So you can always get it there, or you can email me directly, Gillian@masters.vc. Again, tons of these links are available also on the LinkedIn page. It's Outlines, plural, Venture, singular, group. So Outlines Venture Group on LinkedIn. You'll find all the backup to all of these crazy stats. Let's see if we can get this going. Perhaps. Okay. We're going to talk about some sustainable investment models, and we're going to begin with a bit of history. This fellow is a real underachiever, as most of you know, Georges Frédéric Doriot. He was kind of known as the founder of conventional venture capital as we know it today. Certainly venture capital has been around for eons, but it was born in about 1946. The object was to fund innovation, and I quote there, fund innovation. It was designed to capitalize companies being started by the GIs returning home after the Second World War, when they had bright ideas. And these gentlemen who formed ARD thought that 2% of their investments would pan out and the balance would be duds. These were moonshots. And we still use this technology today. The United States government got involved with this. They wanted the innovation that would power the existence of human beings on this planet to happen in the United States. So there were advantages in things like the carry that they're just revisiting today. There were other advantages as well, of course. Now, the following should give everybody pause, regardless of whether you're an investor, an entrepreneur, or if you're a civic leader and thinking about the companies that are being launched in your city. 80% of all conventionally venture-funded startups will fail within 5 years. This is within 5 years. Another 16% on average will not sell or have an IPO, or in other words, go public. That means they return nothing to their funds, because the way you get your capital out is through a sale or an IPO. About 4%, actually 3.78 something, will have a happy exit. And a happy exit is defined as 2x to the investors net of fees, 2x. So nothing like 10x, 100x, or 1000x. These are not the unicorns. So the question is begged, are venture capitalists making a mistake on 96% of their funding decisions? And at this point, usually most people chuckle and say, well, I hadn't really thought about it that way. And I would posit, how else would you like to think about it? It's their job to make sure that there's a return on investment in the fund. And only 4% of the companies are doing so. But let's get a little perspective on this. They actually did a fairly good job. In the end, it's about 4% that have a happy exit these days. The original model was to invest in a large group of companies that one expected to die out, and 2% would make it. So in truth, they did quite well. Right? The problem lies in the fact that this is a very specialized form of capitalization of companies designed for moonshot thinking companies, and it is being slathered over just about every technology startup on the planet, whether it has an opportunity for something like a 10 or a 20 or $50 million exit, or whether it's $500 million, $1 billion, or $1 trillion. So let's take a look again at a little more perspective, this one from the Kaufman Foundation. They pointed out that since the 1990s, conventional venture capital has not kept pace with the returns of the public markets. Okay, the public markets have returned approximately 8.8% over the last 20 years and 11.4% over the last 30 years. And now I have to ask your forgiveness because I'm trying to remember these numbers rather than reading it from my notes. The very finest ones, if I've made a mistake, I promise I'll send out an email with the errata. But if you get the deck, I will give it to you in PowerPoint and you can read those notes. So you'll be 100% sure you have the exact number correct. The point is that when you look at the public markets, that means that venture capital has been returning lower ROI. And since 1997, this is far more worrisome. Conventional venture capital funds have taken in more cash than they have returned. In other words, you don't get your money back. You might get some of it over time, but not all. Again, one has to say, did they make a mistake? And the answer is we think not. Right? These are the finest and most promising companies on the planet. We think they used the funding model that was incorrect. So we're going to take it to the meat of our conversation today. We're going to ask you to take a look at taking a scalpel to this job and stop taking it to it.
So he writes that loan agreement with the bank, a $6.6 million loan agreement, establishing the covenants, believing they're in his favor without running them by me first. They
Is there-
personally guaranteed it for $1 million. And he wrote in there that liquidity must be maintained at 400,000.
Sir, please go on mute, Richard.
I'm not. So was Richard asking a question, or did we just have a? I couldn't hear him clearly. Did anybody get that clearly?
I think he was just accidentally not muted. You can probably go ahead.
Okay. Okay. Then we'll head on into, the Netherlands here. Here we go. Oh, wait a moment. I have to get this thing reshared, right? And there we go. Share screen, go back. And again, you should share this, you should see the screen at this point, and now you should see it full screen. Is that correct?
Looking good.
Okay, thank you. I trust you. Okay, here we go. All right, so I'm going to ask you to consider that any startup doesn't really use one piece of IT, they use an IT stack. Think about capitalization in the same way. You're going to need a different kind of capital to get you over the water here, from the oceans to the bay, into the lowlands and through the forest and up the lowland hills, and then over, of course, the mountains to the promised land. It is a different form of cash, a different form of capitalizing, and you're going to need all of them along the way. Finally, I think venture capital is seriously evolving. These things have existed for a long time. This is not really news, but at least we are finally applying it to technology companies as they come to see us as investors. So venture debt versus venture equity. Venture debt includes things like the bartering, crowdfunding, and so on. I'll let you read this all by yourself. And we're going to cover a few of these so we get a sense of what's possible. And let's get real about conventional venture capital. I keep using that term, conventional venture capital, because there are other venture capital options available to us, and we'll set those aside separately. But as you have accepted even $1 of conventional venture capital, you've agreed to two things. One, you've agreed to sell your company, and to do so as quickly and expeditiously at as high a valuation as possible. And number two, you've agreed to work at the pleasure of your board, and you can be replaced. So as entrepreneurs, everyone should be asking, are you sure you're ready to make that deal with the devil? And if not, you're not a good match for venture capital. And yet I see so many entrepreneurs, as I'm sure my fellow investors here do too, with eyes as big as saucers when you mention such a thing. Think about it. Now let's also consider whether or not a venture funded company is actually more profitable for founders, or whether they should be looking at things like venture debt. My co-founder at Moz, formerly known as SEO
model associated with this object.
Again, was that a question, or do we have a sound interruption?
You're good. Keep going.
We're good. Okay. Rand Fishkin is my eldest son and also my co-founder at Moz, an unusual business relationship. It was wonderful. Nevertheless, he wrote this book called Lost and Founder, following his experience with conventional venture capital. He was one of those founders who clearly said, you will drag me from this place kicking and screaming and pulling my nails through the floor in order to get me out. I love this so. He's a founder who wanted to stay put. He did not want to exit. It was a bad match. Now, here is a chart that's very simple, comes from that book, and this is really for the entrepreneurs among us today. Consulting versus business product. Often we are told as entrepreneurs by investors, and I am guilty of same as an investor now, that product is scalable and product is fundable. Consulting is not. And if you get more than maybe even 15 or 20% worth of consulting in your gross revenue lines, then you have a problem in getting funded, right? You only have that problem if you're seeking conventional venture capital that is designed to fund moonshot companies. It is not impossible to capitalize the company. It just isn't a good match for that kind of funding. And you can see here just the bottom line. I'll let you go through it. $15 million if you exit by yourself, $6 million if you exited even 4 times that sum, and more at 40 million, almost 5 times. Okay, look at the numbers, figure out what's best for you. 92% of venture-backed companies see an early death. Now, we said before it was 80%, but once you hit the Series A, it actually increases, and about 8 to 10% over year, companies that will survive the Series A funding and move on from there. So consider all of the ways to capitalize, and let's go. Bartering is a very overlooked kind of thing. At the very earliest idea stages, when far too many entrepreneurs are approaching us as investors and we're saying, well, we'd like to see a product in the field, you can do these kinds of things early on. Trading things like marketing services for coding, brilliant. It is non-dilutive. Start small. Right? Get the job done. Don't approach investors too soon. Bridge loans. Now, bridge loans come in many different ways. You can make them venture debt completely. There are also ways to play that according to, if you will, with a twist on venture equity, and we'll get into that shortly. But sometimes a bridge loan is all that's needed to get a company from a product in the market to just enough capital flowing that it can become profitable and head off on its own. That's all that was needed. Just set an appropriate term. Revenue share agreements. Revenue share agreements are loans which, like Lighter Capital right here in Seattle, for example, are loans that are based on the revenue that you're bringing in now. So you take a percentage of gross revenue at Lighter Capital, it's generally about 6%. And it is the loan is paid back starting immediately. So 30 days after you get the loan, you'll start paying them back, right? But from a top line gross 6%. This doesn't harm the company in its own process of moving along and growing. And at the same time, it returns the capital to the lender at an appropriate rate. Those kinds of things, venture debt, make all kinds of sense again when you don't want to dilute the stock at the time. Now, Lighter Capital bills itself as non-dilutive growth funding. They took factoring out of the 20th century manufacturing world, nominally put it into the 21st century in the technology world. They didn't pay that marketing guy enough. Okay, dividend models, a little bit similar again to the public markets here. If you have, well, let's see, first thing is an investor puts in cash, the company hands out stock, the holder of the stock hangs on to it. They can even fund the launch of a company, the building of a product, and so on. The founders inside the company may take a very small or low salary commensurate with whatever's in the market for the time being, but when they wish to take more money out of that company, they don't do so by salary, they do it with a dividend. As a stockholder, the investors participate. As the largest stockholder in general, the founders participate at a higher level. It's good for founders and it's good for stockholders if you're in it for the long haul. You can also, again, take a scalpel to this job, and rather than simply declaring dividends, and this can go on to your grandchildren's grandchildren, you can write in that once you have received, say, 3x, 5x, 10x, whatever you like, right? Then the company will repurchase the stock. And you can again determine how much they will pay to repurchase that stock. And you can be on your way. There's all kinds of ways to come and go, even inside a dividend model. Royalty agreements. Well, yeah, at least I've got your attention. It's not that kind of royalty agreement. But a royalty agreement enables an investor to invest not only in a company, but perhaps instead of the whole company, just a product line. Think about music, games, pharma even, technologies that would be APIs and so on, right? If you're going to get a licensing agreement out there that people can license the technology, right? You can have an investor invest in that particular piece and be reimbursed by the royalties of that particular item. You could give them 100% of the royalties for, say, I don't know, a year and a half, 2 years, 10 years. Or you could give them a percentage for a longer time. Again, take a scalpel, figure out what works for both the company and the investor. Conventional loans, loan sharks, right? Often considered dangerous and not a good idea and so on. Again, depending on the kind of company one is building, it actually isn't such a bad idea. You can do things like mortgage your house at unprecedented low rates. I mean, they were even under 3% for a while, and now they're a little over. You know, if you have a residence and that's what you want to do, great. Have conversations, entrepreneurs listening in today, with your significant others. Decide between you what you will and will not hawk, if you will, right? What's going to be the collateral. Will you mortgage the house? Will you, I don't know, hawk the family jewels? Maybe you will do just that, but you decide what the limits will look like. It's actually something to consider. Crowdfunding. Crowdfunding is great if you have a product. In this case, this is a fancy little game called Odd Fauna. And as of yesterday, these wonderful folks had raised, what is it, 180,607 whopping bucks. And they were trying to raise, I believe it was 15,000. So they did very nicely. If you have a large following already, that's great. If you have a product that can be pre-purchased, that's great. Again, it's completely non-dilutive. Consider what you're building and whether or not it's appropriate. Non-accredited investor platforms are often also called crowdfunding platforms. And while they technically are, the terminology is right, it is a bit confusing because these folks do get a piece of the action. They get stock. So considering that, that's a possibility as well. But again, non-accredited, I got to tell you, as investors, it's as dicey as any other kind of investment. You're still going to hang on to this for 11 to 16 years, not the 3 to 5 that we all hope for and remember from 1995. Structured equity funds. I promised I'd get to you about this kind of a hybrid model that looks a little bit like venture debt and a little bit like venture equity. These two gals are raising a structured equity fund. I'm the one on the left. My colleague is Ann Kennedy on the right, and we are the managing directors at the Mastersfund. We run Outlines Venture Group, which will launch this Mastersfund. I'll tell you a little bit more about how this stuff works. With structured equity, we invest cash in redeemable preferred stock, not just preferred stock. That means that the company will redeem the stock from the fund, buy it back from the fund at a preset multiple. Generally, it's about a 3x, sometimes a little more, a little less, but generally 3x. And they will do so when the company reaches a certain benchmark of gross revenue that, again, we predetermine. Everything hangs on good due diligence and financial modeling. Very much like Lighter Capital and all of their colleagues around the country and around the world that offer that on the debt side. We do so with a cash investment and redeemable preferred because we can hang on to it. That's how we get to the survivable warrants. If the warrant is if we still have the stock and it has not yet been redeemed and the company has an exit, we participate 100%. If they've bought some of it back, we participate in the remaining piece and we get 50% survivable warrants. That means even if you've bought every single piece of stock back from the fund, at that last purchase of the stock, that date, that's when the 60-month survivable warrant kicks in. And if the company has an exit in the next 5 years, we participate at 50%. So 50% is decent. It gives you a protection against an upside that you might miss out on, especially since you've already gotten your 3x back right to the fund. Pretty much an 18 to 20% year-over-year compounded return for the investors, which is a very honorable exit as well. The balance is a good piece. This is really designed for companies that don't intend to sell in the next 5 years, or perhaps not at all. So those kinds of opportunities are available. We can fund a much broader group of companies. Consider the numbers I gave you at the beginning. 80% of venture funded companies will go bust in 5 years. 16% carry on, but do not return an ROI to the fund. If we focus only on this 16%, and whoops, okay, Jeff turned up. Okay, if we focus only on the 16%, right, and we provide them with a clear path to exit, an opportunity for an off-ramp, right, we can get something returned to the fund, and often it can be significant. right? Mutually beneficial agreements, I shouldn't have to say it, but I am again astounded how often agreements for investments are consistently one-sided, if you will. One side or another is going to end up in court with the other one. It's just foolish. Always focus on mutually beneficial agreements. So advantages for structured equity, we believe, are for the founders. It's investment, not debt. And while I know our government is looking at the advantages and disadvantages of this kind of investment or that and so on, in general, it has given us tax advantages and perhaps other advantages as well. For example, now we can still use things like the opportunity zones because it's an investment. So there are chances of some interest there. It puts stock back in the pockets of founders. With the founders, right, if you're taking investment, not debt, then you're not carrying the debt on your books. It opens opportunities for other capitalization of the company that was not available, right? If you have non-strategic investors, early investors, it's a way to offload them and give them a decent return. Right? Friends and family, early angels, and so on. These are usually not strategic investors. You can let them go. You don't have to let everybody go. Right? Again, choices, a full capitalization stack. And with a structured and revenue-based return, you are not hit with a bill you can't afford. Now, for investors, again, it qualifies for advantages like this opportunity zone, right? It's risk mitigated in the venture capital portfolio, right? The numbers around venture capital are not great. 51% of all venture funds don't return even a 1x to their investors. This is craziness, right? It's kind of all risk and the reward is often not there at all for far too many investors and LPs. Even inside venture capital, which is arguably a very high risky asset class, right? You can mitigate risk. This helps to do so. It diversifies the venture investments and it increases the speed to ROI. Time is a risk factor as well as a cost factor. There's the cost of capital, and you can know pretty much what you think is going to happen in a year or 18 months, or maybe even in 3 or 4 or 5. You're already getting pretty dicey. Right? Now, if you're going to tell me what's going to happen in 11 to 16 years, well, I want to see that book. Increasing speed and consistency of your ROI within a venture capital portfolio is something we should all be looking at, especially those of us at the earliest stage who are far too often beat up by dilution and the length of capital tie-up. In my case, for example, I'm going to be 67 in just a few weeks. If I have to tie up my capital for 15 to 16 more years, right, I'm too old to care. I need a better way and sustainable way to invest. So what do we do about this? We've got a lot of different pieces of information, some of it good, some of it others, and so on. I would say my first counsel is mitigate risk through the diversification of investment models. Look at all the models as investors, look at all the models as entrepreneurs, come up with mutually beneficial agreements so that the two come together with clear expectations and a much higher chance of successful exit. Reduce your time to exit. Come up with ways in which you can take at least a piece off the table. This is why we came up with this venture, this equity, right? Structured equity. We'll take a piece of it off the table and we'll put a piece of it on for the long run, right? We're not going to bet the whole farm on one or the other. And then I would say, let's stop chasing only unicorns. Since 1946, there have been an average of 8 unicorns minted every year, 4 of them in the United States. Over that time, there's an average of more than 10,000 investments per year in the United States to see the 4 unicorns. And it's, of course, not the same investment in the same year, right? More than 10,000. They really are scarce. Think about funding real companies. If you're sitting in the Seattle area, I am not today, but usually I am, right? You can look into the downtown core and you can count on 2 hands with fingers missing the number of companies in the technology space that are not early stage startups and they are not, unicorns. They're not the Amazons, right? There's somewhere between 100 and maybe 600 or 700. That's not a bad size company. These are the mid-size entrepreneurial privately held companies that are the cornerstone of economies worldwide, not just in the United States. If I were the mayor of Seattle, I'd be scared. What happens if any of those unicorns start dropping their hiring of technology companies? Right? There's an insufficient number of these privately held mid-sized corporations to pick them up. The stability is not there at the base. Right? So it's not great for civic organizations, not great for entrepreneurs, and not great for investors. We can improve it. Use funding models that are going to enable these companies to thrive long after you exit. It's important not just to you, but also to the communities in which they are supposed to thrive. And I would also suggest that you find capable founders in uncrowded fields. This is the conversation du jour, right? It's about diversity at the leadership levels. But take a closer look again. I didn't choose this because, you know, it was just a random photo. These guys really are, if you will, all the same, and they're all guys, right? But the reason that, if you will, these tall white men are, you know, funding themselves, right? 98% of capital goes to men, more than 66%, well, 2/3, right, will go to tall, white, American-spoken, slender, youthful, able-bodied males from Harvard or Stanford, just 2 universities, the entire world, with a baritone voice. And everything, including the baritone voice, is points off. So that's kind of nuts. And you go, well, should we rail against this? And the answer is no. This is vestigial anthropological behavior. The humanoid infant that cozied up to this saber-toothed tiger 30,000 years ago didn't last long. All right? We must cozy up to our own kind. And it's not only humans who are comfortable and safe with their own kind. It's all mammals and the birds and the fish and even the plants of the earth grow in clusters. So if this is essential survival behaviors of carbon-based life forms, we're not likely to change it. The money has to come from different hands and go to different hands. So how do you deal with it? One, yes, you acknowledge it, understand how it serves you and doesn't serve you as you make your decisions. But I would counsel that every one of us, entrepreneurs and investors alike, make close relationships with investors who are not exactly like yourself. Your common ground is that you are investors. And as you have trust and faith in those investors, you can follow, and they can follow when you invest. And in this way, we can move forward. If, for example, the top 24 VC funds across the planet took just 1% of their invested capital and allocated it to, if you will, emerging fund managers of varying kinds around the world, we would already have more than $1 trillion invested in those kinds of things. Good ideas do come from the tall white men. The entire, I don't know, built environment of the planet was made by these guys, and they did a good job. But it doesn't only come from this small sliver of the human genome. And we have problems that need solving beyond it. So I'm Gillian from the Mastersfund. We're raising $100 million fund to capitalize technology companies. And we do focus on those that, if you will, build better ways to live and work together. Thanks so much. Let's talk.
Hi, my name is Rohit. Can you hear me?
Yeah.
I just had a question.
Sure.
It's about, I guess, advisors. So for many of these funding models, all you will get is money, but for some of them, you get an advisor as well. And I was wondering if you were raising through something like crowdfunding, for example, what is a good way to also get an advisor, and what would be a fair way to compensate them if you're not, raising money through equity?
Right. And even when you raise money through equity, you may get an advisor, but only if it's a strategic investor will you get an advisor who knows enough about your field to be able to do things like open doors to key employees, key reference clients, help you with understanding the business models of scalability, whether it's your model in, I don't know, SaaS or whatever it is you're doing, and so on and so forth. So I would suggest that regardless of where you raise capital, you want to rethink how you're also going to be filling your advisory board. A short list. If I could have anybody on the planet, who would it be? right? And then you come up with massive luminaries. The likelihood of getting them very, very slim. So then you think, okay, who else has positions that are similar? Someone who would consider this. And then start higher than you think you should, right? Reach out to people who perhaps have built, I don't know, level 1 of whatever you're building level 2 of, right? The earlier version of whatever it is you're doing. Those guys know what you're doing. If one of those folks think, oh yeah, we built it and it was great, right? And you are the next generation of it, then that's not just an advisor. That person is also, if you will, validation. And that's actually useful in raising future capital or in getting those clients going, because then they say, oh yeah, this guy really knows what he's talking about, or this gal knows what she's talking about. She built version 1 and she knows that you're version 2. I would be looking at it that way. I would not necessarily combine capital with advisory services.
Thank you.
Oh, and in terms of compensation, Techstars has a lovely compensation chart. Founders Institute has one. They're just all over the web. Just say, you know, advisory and board of director compensation, and you'll find these little charts. It's probably less than what you consider. Don't give away 10% of the company unless their person is, you know, working full time for you and so on. So again, it's really like 1% or 2 or 1/4% and so on. It depends on what they put in terms of time and effort, and what stage, and of course, how they are counseling you, whether it's around technology or around business or something else. Okay. You'll find those charts.
I'd love to ask a question. First of all, I just want to say thank you so much, Gillian, for just being so concise, and like your experience really shows through. It's just like boom, boom. So I've been an entrepreneur literally since I was 10, and I had a happy exit for myself in the photo space about 4 years ago. Then I went traveling, I came back and I started something similar. And the reason I sold the last business is that my partners didn't have as big of a vision as I did. They were kind of overwhelmed by the business going international. And so I'm doing something similar. It's a advertising subscription model. I want it to be in all genres of photography, but I started it just in the wedding space, sort of laughably 2 weeks before COVID happened. And
I launched a fund 36 hours before we imploded. So, you know, good timing.
Yeah, good timing. But in the same token, I'm actually grateful for that, because I feel like it gave us time to build brand, social media presence, what have you, to think, you know, with new strategies about how to build relationships on a deeper level. So actually, in retrospect, you know, I wish COVID didn't happen for the world, but for me, actually, I think it worked out okay. We were able to bring about 100 new members on last year with literally hardly any sales. I think we turned down 200 inquiries because we're kind of a vetted art gallery. And
help, Blair, though, what would be the question around?
Yeah, so this new business, we're just starting to see, you know, real decent growth now that things are coming back on in the US. And so our sales are going up. But on the technical side, we could move 2 years faster with investment. So because we need to create a larger site, right now we just have a genre site. And so we want to create a larger site that will umbrella multiple genres. And I really need somebody who has a lot of sense in tech. I've, you know, made my way through the years, but what I'm looking at going forward with possible app and things like that, kind of looking for a CTO that would be, you know, really brilliant.
Yijing, are you there? Are you still there?
Yes, what's up?
There was a group in Seattle where we went to literally to find co-founders. Lots of CTOs were hanging out, COOs and CEOs and so on. And the whole purpose was that we would meet each other. Do you remember the name of that organization? Founders
It's
Meet?
Founder Dating. It was run by Brian Schutz, but I'm not sure that it's been operating for a while, right? So I wouldn't.
Check it out again then. Founder Dating and Brian Schutz.
Yeah.
Okay.
FTHULTZ.
Gotta try, Blair. If they're not there anymore, I would kind of do a search, Founder Dating, and keep asking, is there's such a group, and of course it would meet by Zoom these days, but who knows, shortly it may meet again in person. So yeah, be very mindful about it. I would post things on LinkedIn, on Reddit, find out all the spaces where a CTO that needs to build what you're building is going to be hanging out, and let them know that you're seeking people. Don't be shy about it. Sooner or later, somebody's going to say, I know somebody.
Yeah, okay, yeah.
Gillian, yeah, could I ask you about how it's going from the perspective of LPs so far? I really like the model, and I think it's a good balance in terms of risk on both sides. But we were looking at a similar type of model, and one of the things that keeps coming back was the fact that for the entrepreneur or for the angel, there's a little more of a it's less institutionalized, right? There's more of an individual consideration with each company. But when it comes to LPs, it's VC is just one piece of their strategic portfolio, and so having a lower risk approach didn't necessarily fit with the way that they were seeing investment. And so even though it made sense and it appeared like a better answer, they were kind of like, well, yeah, but 95% of my money is already in something that's rational and reasonable. And this is kind of my $1,000 I'm going to spend at Vegas kind of thing. And so how does that fit? And what kind of feedback have you been getting from LPs in terms of that fund? And how are you addressing those challenges around the way people think about their portfolio?
So interestingly, I did hear that from a couple of individual investors. There was one family office as well, where they said, well, we want to shoot for the stars on this. And I said, well, that's way cool. And if you're also looking to capitalize companies with diverse founderships, founder teams and so on, those kinds of things, and you want to do so on a consistent basis where you can roll your capital more quickly, you can do so even with philanthropic dollars. That became quite interesting, actually. People can create a foundation and they can amplify the value of their foundation's dollars by investing in those kinds of things. And then it rolls over more quickly, and any capital that comes back goes back to the foundation, and they get to redeploy it. So we found that worked very nicely. The second one was around institutional capital, and that one surprised the heck out of me. The Kaufman Foundation, of course, the report's fairly famous, and they looked at their, 10, 20 years worth of investments and so on. And they were the ones who were saying that it was kind of all risk, no reward, and they weren't really getting their money back, and so on and so forth. And they looked at it and kind of thought, well, yeah, they do want to balance even the high risk portfolio with something that can more consistently return something around the 18 to 20%. Even if it consistently returned around 14 or 15%, it would be better than the public markets by a bit. It would fulfill their social goals as well as other goals in terms of investment and so on, and would provide this piece of upside potential. So that seemed to be the right thing. I was surprised. I thought the institutionals would say, no, we have 11 to 16 years to hang out. We deploy it once, we don't care. But it turned out not to be.
Okay. So what has been your biggest challenge in raising this $100 million fund?
It's a first fund. We'll be clear. First funds are hard to raise. I was told when I started that it would be a 4 or 5 year proposition, and I should just get on with it and recognize it. So we're only in year 3, and we will close the first fund, and it will be exceedingly small, and we will start from somewhere, and then we'll get on to the next, and finally raise the 100 mil. But a first fund is 1, hard to close. 2, it is women-led, and that is still unusual. Female GPs are not common. And then finally, we're using a different funding model. And so there was an education piece, and we're certainly at the bleeding edge of that. I wouldn't say we're completely ahead of the curve. I think we're right there, which is nice. And that's why we've been able to at least close our first fund, even though we, again, don't have the track record to prove it. We only have our personal track record because we've been investing this way for some time individually. So the balance has been there. I think the most difficult piece literally was the fact that we didn't come from wealth, either one of us, and we did not therefore have neighbors and friends whom we could turn to for that first fund. We couldn't raise, 10, 15 million out of the gate. COVID was tough. We had to do this with Zoom and similar kinds of platforms. And it is, how should I say, any conversation on the planet is kind of a sale and a buying thing, whether even if you're deciding who's going to do the dishes. It's also about connecting on a subject that has nothing to do with the issues of things. They happen when you meet serendipitously. They'll happen at a conference, at a meeting, a lecture, or this or that, and you connect because you both ride a bicycle, or you connect because the weather was foul and you both got wet. Little things, right? It doesn't happen here.
Mhm.
So that was really, really tough. It was about the conversation.
Kathy, we're not hearing you.
Yeah, locked up. I'm not sure if that's Kathy's side or mine.
Yeah, I don't know. Can you hear me? No, I guess not. It must be just my computer. Thank you. Yeah, all right, great.
We can hear you now, Kathy. What were you saying?
Oh, okay. No, question on your attitude, Gillian, towards venture capitalists being very involved. I have a couple of investments, recent investments, where I've seen a shift over the years in the venture capital model where they actually are almost like a de facto. They'll put in a significant amount of money early on, but they also will have assigned one person who has who meets with the company once a week or once every other week. And I'm wondering what to me as an investor, I have more visibility, even though albeit I'm a smaller investor, but I also really appreciate that model. And I'm wondering whether that's just a trend. What is your impression of doing that other than just giving money to actually become involved in the company?
I don't know if it's a trend. I think, even when I was raising capital at Mazda, 15 years ago, has it been that long? Yeah, about. And it was, there's some did and some didn't. There were engaged VCs, and then there were just, write the check VCs. And there were a lot of conversations around whether it was better to have one or the other. At the Mastersfund, we're very engaged. We invest in companies where we have deep bench, if you will. In other words, serious experience, and one person is assigned to manage the company. The object, however, is we don't ask the question, can this company return a unicorn-sized exit? We ask instead, can this company return an ROI commensurate with the risk of the asset class in a reasonable period of time? And so those are the different pieces. And then we help that company to focus on early, steady, and solid revenues. And we feel that helps them get to the next stage, even if they are going to go for that Series A, B, C, D, and so on. Because it's the first fund, it's very tiny, right? We can only write angel-sized checks. We can collaborate with others and syndicate, that's fine. But still, we're not doing this at, say, the Series C. We're doing it at a seed between this and the Series A. So we help these companies get over the hill to do that, or we help them get on their way and they never raise capital again.
And what would engagement look? What does engagement look like to the Mastersfund? How would can you get down to?
We literally take a seat on the board. We take a seat on the board. Even if it's an LLC or something, we say this is going to be a board and it will meet and we will discuss these issues, and there will be, kind of the formalization of the board process, regardless of the license of the company itself, whether it's a C Corp, an S Corp, or whatever, it doesn't matter, right? So we take a seat on that and we work with the company. It meets no less than monthly. We don't do it weekly, but no less than monthly. And sometimes, again, mostly in the beginning, the person who takes that kind of advisory position, if you will, they do meet weekly. I mean, it's a lot of work in the beginning, and then they're kind of off to the races. But this is the engagement of anyone who takes on advisory work, right? You're terribly engaged in the beginning, and then later, not so much.
Thanks.
I have a question about your Mastersfund. You didn't mention what fund or the range of cash fund, and also at what stage of investment. Like, is it like a Series A or initial investment?
Right. So as noted, we're a really small fund. We're going to close right about $1 million or $2 million or so on. Then we immediately raise the second fund that will start in July, and we'll be closing this one in June. This is the first one. And we are writing checks as little as 50 or 75. We will write up to about 150. As the money kind of turns and cycles through, some of the capital returns immediately goes back to the investors. We're looking to get a 1x back to those investors in about 5 years. If I can do that, I've done better than half of all the funds out there already. Right, just that much, and then everything else is gravy. By plowing back in some of the returns as it comes in, we are able to deploy more capital than is actually invested over a period of time of about 10 years, right? But it keeps rolling. We expect our first returns to be as early as 24 to 30 months, and we expect our last returns to come in right at about the end of that 10-year mark, because again, we'll be cycling through. When we began this process, we thought that companies would be able to begin redemption again, because we come in at the first turn of revenue. So we're talking about before a seed even, or between a seed and a Series A. We come in at the first turn of revenue when they have a product in the market. They have at least 2 or 3 willing buyers who have paid them for this. This is not a pilot. Right. And then we amplify and replicate the marketing and the sales and so on. So if they reach that new gross revenue line, from a piece of that, they begin to redeem the stock. We thought that it would take 24 months to begin to redeem the stock. As we are looking at those first companies coming through and getting to our first investments here at the fund, as opposed to the work that we had done individually before, we see that it is actually increasing over time because we are getting so much inbound flow. Just kind of word is going out to entrepreneurs, not just here, but kind of worldwide. And so on, because the inbound flow is there, we're able to select those companies that can begin to redeem in as early as 6 or 8 months. They just need that last push over the top. And it is extraordinary to me how many companies need a small amount of cash, somewhere between literally 50 or 60,000 to maybe as much as $500,000 or so. That's it. And it gets them over the hump. Right? Some of these companies will go on to raise Series A and hope for the unicorn. Many of them will not. We can fund a broader group of companies and see a higher return of capital. So that's what we're looking at.
Hey, Gillian, thank you for your time today. A quick question for you around Mastersfund. So when you're evaluating founders that you're working with in terms of their leadership long-term, are you strictly looking at KPIs and metrics of the company, or are you also evaluating your working relationship with those founders?
So when you mean during the due diligence process, what says invest and what says don't?
Well, that, but also in terms, you mentioned earlier on about the dragging founders kicking and screaming away from the project, depending on when they want to exit versus when you want to exit. So I kind of wanted to kind of get your philosophy in terms of Mastersfunds for that.
Okay, we were doing a little cutting in and out. I think what I heard you say, so just say yay or nay if that's the right question. I think the question is, how do we determine at what stage a company will begin to redeem its stock? At what gross revenue it must reach? Is that correct?
Can you hear me now?
Yes.
Yes, ma'am. Yes, ma'am. That's the question. Go for it.
Okay. Good. All right. So what we do is we run a financial analysis during the due diligence process that indicates what kind of revenue they have earned from their initial sales. And usually it's fairly few. Sometimes if it's more consumer related or close to it, if you will, it might be a few hundred or even 1,000 sales, right? And then we say, now, what would they have to do in order for us not to harm the growth of the company? So it might be as little as, say, 75, 1,000 a month or something, or, recurring revenue, or even 20,000 a month recurring revenue. Depends on what kind of sum has been invested, right? So let's say we make a $50,000 investment. In general, we like to get to that 100,000 a month in gross revenue. We look at a company that has the capacity to do that from where they stand today, the volume they're selling now, and they can do that within 24 months. Our surprise is that there are so many companies that have this high trajectory. I will give you an example without naming the name of the company. There is a company that helps physicians groups or clinics and so on to invoice for virtual visits. Okay? And for virtual care. Virtual visits, not such a big deal. There's somewhat competition in that field. But these guys can also provide, if you will, things that monitor blood sugar, heart issues, so diabetes, heart issues, and other, what do they call that, chronic ailments. There are about 5 or 6 that are very common. So they have a pass-through revenue for these products. The insurance company actually already covers that product. All that has to happen is the physician's group, receives the product and gets it to the hands of the consumer. They have the ability then to track the reports coming in, right, and to invoice appropriately for the monitoring of that patient. It improves patient outcomes and longevities and on and so on. The physicians have been challenged to get the right invoicing in. So their physicians are kind of like falling into the boat, if you will. And this group needs to get more to do it and to get more product to flow, right? They need about 250,000 to make this happen. We find that they can begin returning very, very quickly to reach that 100,000 per month and begin taking the 6 or 7% top line revenue. In this case, we may go to 10% because the gross margins are so large. All right. Alliance of Angels, you guys did an investment that was like this. You did it about 3 or 4 years ago, maybe 5 now. I'm probably getting old while I sit here and we've lost a year. It was a gaming company. It was a high gross margin gaming company. And you may have done it as a debt instrument, I'm not sure. But maybe somebody here can tell me exactly how it worked. We just kind of heard about it from the outside. It was a reasonably short-term investment in which there was, I think, either a 2x or a 3x or something return that was paid from the gross revenues of that game. It launched, it did well, and Alliance of Angels did well, is what I heard. Does anybody have details on that?
Well, the company is probably Sharkbite, and if anyone wants to talk about it, feel free to send me an email. Right, I prefer not to discuss, like I guess it was a private contract between ourselves and the company. Right, but the company was Sharkbite Games.
Okay, so it's Sharkbite. Okay, and you can get the particulars right there, right? So it's not actually, as I say, that new a model, and it's not the only one that's out there. Right? It's just so many choices. It could be venture debt. It could be venture equity. You decide how you want to play with it. We particularly made a fund around this one, but I'm kind of a fan of all of them. Find a company, see what they need, and figure out the best way to get your capital back out with a reasonable ROI. And the reasonable ROI has to be somewhat more than the public markets can offer you. I mean, these days you can get, 8 to 12% in a REIT. Right? You better do better than that. You can do structured notes, and so on. I mean, being launched by, Amazon and GM and who knows what, right? And they'll give you somewhere between 12 and 15%. Now, there's no floor. So yes, you can, well, no, that's not true. Sometimes there's a 1x floor, so you just get your cash back out, right? You can get these at RBC. You can get them at Voya Capital, at, Ameriprise. This is not difficult to get. Your returns in private equity have to be better. So commensurate with the risk of the asset class, consider those things. And then how would you do it? I have a colleague who just does short-term loans. She does it out of Washington, D.C. She's making loans at about 15 to 18%. And it begins to get repaid, within 30 days of the time she makes the loan. And hers are standard payments as opposed to percentages of gross revenue. But she, again, works deeply with the companies, meets with them somewhere between once a week and once every 2 weeks. She just makes sure she gets her money back. She's doing great. So many ways to do this.
Any more questions for Gillian?
Thank you.
I have one more if nobody's going to ask. Do you see this model being possible with startups pre-revenue? I know your plan is that they already have revenue, but do you see a model like this working pre-revenue?
Yeah, it's just greater risk. And so you'd have to decide, do I want to shoot for a 3x or a 4x or whatever it is? And how long will I have to wait? Time is a risk factor and a cost factor. If they're pre-revenue, it's going to take longer. And if they're pre-revenue, they have not yet proven the market. You're not sure that 3 or 4 people have already agreed to pay whatever it was they were going to charge, and the darn thing works. And now we just have to replicate sales and marketing. It's a lot more risk. So yes, it can work, but you'll have to decide what the numbers have to look like.
All right. So we're actually all out of time, but I'd like to thank Gillian right, for spending the morning with us and for sharing with us all her thoughts and insights and analysis. Very, very, very much appreciated. And also thank you to everyone for joining and for participating and engaging with us today. All right.
Thank you all for the pleasure of being here. Several of people have asked for my email. I put it into the chat, but also you can see, oh no, you can't see the screen, sorry. It is Gillian with a G at masters.vc. And I'll chew your ear off about this at any time. And we're very transparent. We're happy to share what we've done, how we've done it, and see if we can help you do better as well.
Yeah, thanks very much. And we will be sending out the presentation and the recording will be available on YouTube. All right. Well, we wish everyone a great rest of the week. Thank you.
Thanks, everybody. Bye-bye.